Today, we're going to talk about an event that sent this massive shockwave through the financial world. And it wasn't caused by some big disaster or a company going bankrupt, but by something way simpler, just a name. This is the story of the Warwick shock.
So let's start with a number, $2 trillion. I mean, that's 2,000 billion. It's a number so huge, it's kind of hard to even wrap your head around it.
And in this story, that entire amount, it was basically vaporized from the precious metals markets in just 2 days, 48 hours. Think about it. Life savings, gone. Fortunes, totally wiped out. And it all kicked off with a single, seemingly routine announcement.
So how in the world can one name make $2 trillion in value just poof, disappear? Well, to figure that out, we've got to rewind to the day that announcement was made.
Okay, so picture this. It's a Friday. The markets are on fire, especially gold and silver. And pretty much everyone thinks they know exactly what's coming next. A new Federal Reserve chair who's going to do what the president wants and cut interest rates. The market had, priced in that certainty. The high prices already reflected what everyone assumed was a done deal.
But they were dead wrong. The reaction was immediate and just absolutely vicious. Gold took its steepest nosedive in over 40 years. Silver, its worst crash since 1980. And as all that money flooded from metals, it flooded into the US dollar. For traders who had borrowed money to bet big on higher prices, it was a total massacre.
But this market meltdown wasn't just some random panic. To really get why it happened, you have to understand the war that was being waged behind the scenes. This high-stakes power struggle between the White House and the most powerful central bank on the planet.
You see, this whole conflict boiled down to two completely opposite goals. On one side, you had President Trump demanding lower interest rates to juice the economy and make paying the national debt cheaper. On the other side, you had Fed Chair Jerome Powell, who is haunted by the nightmare of runaway inflation. His job is to keep prices stable, not to help a president's political agenda. And the president's reasons were pretty straightforward. The national debt was ballooning to over $38 trillion. Lower rates would save hundreds of billions in interest alone. Plus, he needed to cancel out the price hikes from his own tariffs and, of course, fire up a booming economy he could ride into the election.
And this is the really crucial point. This went way beyond a simple policy debate. The president was out there publicly attacking the Fed chair, getting rid of board members. It was a direct assault on the independence of the Federal Reserve. It was a fight to decide whether the economy serves politics or if politics has to respect economic reality.
Which brings us to the man at the dead center of this storm, Kevin Warsh. His nomination was the match that lit the whole powder keg. But here's the thing, it wasn't really about who he was, it was about what he represented.
You see, the market had bet the farm on a nominee who would be a dove. That's finance speak for someone who loves lower interest rates to get the economy going. But Warsh, he was a hawk in dove's clothing. A hawk is the opposite. They're all about fighting inflation, even if it means jacking up rates. And while Warsh had recently talked about lower rates, his entire history was built on the idea that stable prices are everything. He was a total wild card. And that uncertainty just shattered the market's confidence.
In a flash, the entire story flipped. The question went from, okay, how much are they going to cut rates, to wait, are they even going to cut rates at all? Certainty was gone, replaced by pure fear. And that's when the selling stampede began.
And to make things even scarier, there was Warsh's support for something called quantitative tightening, or QT. The easiest way to think about it is, it's the exact opposite of printing money. Instead of pumping cash into the system, the Fed is actively sucking it out. For a market that was expecting a fire hose of easy money, this was like being told a massive drought was on the way.
But hold on, a sudden change in expectations, that doesn't fully explain a $2 trillion collapse. What turned a market dip into an absolute catastrophe was one incredibly powerful financial tool: leverage.
So, leverage is basically borrowing money to make bigger bets. It feels amazing when you're right, but it is absolutely devastating when you're wrong. Let's say you use $10,000 of your own dollars to control a $100,000 position in gold. Well, if the price of gold drops by just 10%, your position loses 10 grand, and your entire investment is wiped out, gone. And then your broker is forced to sell.
And that forced selling, that's what kicks off this terrifying domino effect. As prices drop, more people get hit with margin calls. That's their broker demanding more cash to cover losses. If they can't pay up, their positions are sold automatically, which pushes prices down even more, triggering even more margin calls. It's a brutal, self-feeding downward spiral. You know, as Warren Buffett famously put it, leverage is a weapon. It's what turns what should have been a manageable dip in the market into a personal financial catastrophe for thousands and thousands of people.
Okay, so let's zoom out for a second, because this event wasn't really just about gold prices or margin calls. At its core, this was about the collision of raw political ambition and cold, hard economic reality.
So what can we actually learn from all this? Well, first, if a 10% swing in the market can wipe you out, you're not investing, you're gambling. Plain and simple. Second, and this is the big one, in the world we live in now, political risk is investment risk. All your fancy charts and models, they're completely worthless when a single political announcement can flip the entire board overnight.
And that rush into the dollar, it wasn't just about interest rates. It was a vote of confidence. Warsh's nomination, surprisingly, signaled to the world that maybe, just maybe, America's key institutions like the Fed were strong enough to push back against political pressure. And in a chaotic world, that kind of institutional strength is what really backs the dollar.
Which brings us to the ultimate question that this whole mess forces us to confront. What's the real relationship here? Does politics serve economics, or is it the other way around?
I mean, you're really looking at two totally different versions of the world. In one, central banks are independent, they're driven by data, and they make tough calls for long-term health. But in the other world, they're just another weapon for politicians to get short-term wins, no matter what the long-term cost is. The Warsh shock was a battle fought right on that dividing line.
And that leaves us with a final, pretty unsettling thought. This $2 trillion crash, it might not be a one-off event. It could very well be a preview of what's to come. A new reality where political fights create more chaos in the markets than any economic report ever could. And in that kind of world, certainty, well, that's the rarest thing you can find.